On the subject of Tesla's share prices, there has always been a lot of controversy, with stock prices skyrocketing to over $1,000 last year and dropping again this year. Experts are speculating on the true valuation of the company. Some believe it to be highly overpriced for an automobile company, while others find the stock price justifiable. Why are Tesla shares so expensive? Is Tesla a good stock to buy? Is Tesla indeed overvalued or undervalued? A recently released note by one of the largest financial services companies in the world has revealed that Tesla stock is not as expensive as it may seem. So, we'll be diving into the contents of the note and what financial experts are saying on the matter in today's video, so keep watching. Credit Suisse, a global financial services and investment bank, recently released a note to investors written by analyst Dan Levy. In this report, they dive into why they are bullish on Tesla and firmly believe the company's stock price will hit their price target. In the last released report, according to Dan Levy, Tesla has risen to the upside on margins, in large part driven by cost savings. We believe the good margins are sustainable. Tesla has indeed proven a bit more flexible than expected, especially with them bypassing the chip shortage crisis. Elon Musk stated that the company was able to employ alternatives for chips that were nearly impossible to obtain. Tesla, according to Volkswagen Group CEO Herbert Diess, can rewrite software in a matter of weeks and then just stitch it to a new processor. Tesla's emphasis on software and vertical integration is certainly critical to its ability to quickly adjust and overcome challenges such as the worldwide chip shortage. This level of innovation and flexibility is sure to save costs and maintain healthy profit margins. We believe legacy original equipment manufacturers are making clear moves towards transitioning to an electric vehicle world, he added. However, we expect Tesla to maintain a lead for the foreseeable future. It's no surprise that they hold this opinion, as several experts agree that Tesla is currently a pioneer in the sector. In addition, the memo stated, until now, Tesla's margins have mostly been determined by vehicle hardware sales with some minor software benefits, specifically for full self-drive features. Tesla should see incremental margin when it delivers more full self-driving features and unlocks more deferred revenue, which is anticipated to flow through at 100% contribution margin advantage. On the other hand, since at least 2016, Elon Musk has been promising customers a self-driving car. Tesla's Full Self-Driving Beta, or FSD Beta initiative, allows many employees and customers to test new and incomplete driver assistance capabilities on public roads in the United States. But despite that, the fact that the firm has yet to deliver on that promise is making some investors lose faith. We remain bullish on Tesla. We understand this is a challenging company to value, particularly given the volatile short-term metrics. But we believe Tesla is on the path to be a major automaker, with potential for substantially better margins. We see Tesla as having the only truly differentiated product in autos, an extremely valuable brand, and an ability to move much faster than the competition. The note states two reasons for Credit Suisse's confidence in the electric vehicle brand. Firstly, statistics on the Model S performance are quite good. Model S achieved a US market share of 25% in its pricing group in 2015, as Tesla highlighted in a table in its press release, reiterating a point we've made before: it substantially outpaced its rivals. With that level of global dominance in the sedan and SUV sectors, the combined S or X model would sell over 200,000 vehicles and would imply a price tag of more than $800,000 in the Model 3's price range. Their second point is that Model S was recently named the clear winner in a semi-autonomous comparison against the BMW 750i, Mercedes S65 AMG, and Infiniti Q50S models by Car and Driver. The fact that Tesla had no active safety drive capability until Elon Musk began hiring an engineering staff in September 2013 is quite astonishing. We're confident in projecting that the competition has been developing the skill for at least a decade, the note stated. According to the experts, Tesla remains at the forefront of the multi-decade secular transition to electric automobiles. They predict that Tesla will continue to increase car sales while maintaining profit margins. For the years 2022 to 2024, their earnings forecasts are 25% higher than the Wall Street census. I'm hard-pressed to find any stock that fits all the boxes as Tesla does: an appealing growth path, both top line and earnings per share, disruption, emission reduction, and so on, said Mr. Levy. Because of Tesla's quick development, financial professionals believe the price/earnings to growth ratio may be a better measure of its value. As fresh quarters with higher earnings per share are added, the price to earnings ratio falls rapidly as less profitable quarters are removed from the equation. The price/earnings to growth ratio is calculated by dividing the company's price to earnings ratio by its earnings per share growth rate. Last year, Tesla showed exceptional growth, and it will need to continue growing in order to keep its valuation. While some analysts believe the stock is undervalued, the price/earnings to growth ratio suggests otherwise. Tesla now has a price/earnings to growth ratio of 3.5, which indicates that it is overvalued because a price/earnings to growth ratio greater than 1 indicates that a stock is expensive or overpriced. However, Tesla is frequently regarded as a growth firm, and their price/earnings to growth ratio is lower than that of certain value stocks. The price/earnings to growth ratios of General Electric and American Waterworks are currently 6.6 and 4.59 respectively. Tesla's price/earnings to growth ratio is greater than the industry average when viewed as an automotive company, and many people say that Tesla is overvalued because they see it purely as a car company. Tesla is more than just a car manufacturer, and it has been likened to a tech company on various occasions. They seem to be evolving into an AI robots firm. This is crucial to any firm valuation that can be defended. Yet, many equity analysts have either disrupted or dismissed this reality by claiming it outside the focus of their research. Some say this misunderstanding has resulted in Tesla shares being valued at half of what it should be, claiming that AI-assisted driving is more than simply a nice add-on for a beautiful car. It's a paradigm shift in the driving experience and our understanding of what a car is. As more experts adopt this viewpoint, the popular narrative on Tesla might flip. The stock price could double in the coming years. Credit Suisse upgraded Tesla to outperform because it checks all the criteria in terms of advancement, environmental approach, and market undervaluation. Following this memo, Loop Ventures managing partner Doug Clinton issued a blog post in which he claimed Tesla was overvalued. Tesla is incredibly expensive. They make excellent products, but that isn't the issue. The issue is what the stock's price requires in relation to future growth. Tesla's price does not appear to offer fair odds for a strong future return. There's no margin of safety incorporated in the pricing. He noted that a margin of safety for him implies buying an asset at a cost in which something wrong could happen, but a lot of money won't be lost. Meanwhile, the stock price continues to fall. It's currently down 5.09% at $876.35 on February 17th, compared to its last close at $923.39 on the 16th of February. According to past performance, Tesla stock has a good chance of rising in the coming month. In the last 10 years, its stock price has seen a 21-day drop of 21% or more on 71 occasions, with 65 of these resulting in share prices increasing over the following one-month timeframe, which is 21 trading days. This historical trend indicates that Tesla stock has a 65 out of 71 chance of rising in the future month, signaling that Tesla shares could be a decent choice in the near term. Dan Levy and Trevor Young maintained their $1,025 price objective on the firm. "We believe the stock should recover," they added, citing strong fundamentals ahead and the stock having been caught in the market drop. This is plausible, seeing that automobile brands such as General Motors, Mercedes, and Rivian are experiencing a fall in stock prices as well, but nothing too drastic compared to Tesla. The report also contained a disclaimer: where we could be wrong. Tesla's year-to-date performance. Value stocks have outperformed growth stocks by 12% year to far, while growth stocks such as Tesla have underperformed by 7%. A risk to our call is that rising rates put pressure on secular growers, as any positive outlook on Tesla must use a long-term valuation. In a previously published note, Fundstrat Global corroborated this view by stating that Tesla remains an important long-term investment for investors. The company has laid the foundation in autonomous driving, and we believe they'll remain the frontier company in the field as the demand for electric vehicles grows. Do you agree with Credit Suisse that Tesla is undervalued? Comment down below.